Well, hello everyone. It is Friday, the last Friday in June of 2024, Friday the 28th. I am Delbridge, Benchmark Realty, Murfreesboro, Tennessee. We're going to hit a pretty broad show today. I think it's going to be a darn good show. So we're going to have us our darn good show, and we're going to start with good, we're going to end with good, but we're going to look at some of that information that kind of sends us mixed messages right after this. If you like this content, please go to CallDelToSell.com, find the tab that says on YouTube, click it, and it'll open up a page of QR codes. There you can use a smartphone to scan and get to the YouTube page, or you can just mouse over and click it on a PC. There you'll be able to subscribe to this little button over here and click the notification bell so that YouTube will notify you when each Friday's blog has been uploaded. Thank you. Okay, so we want to start with some good, and we're going to answer the question, is the market crashing? Are homes crashing? Well, I would say probably not. Now, this is my Benchmark Realty, my personal page, the CallDelToSell.com website. This is your first stop you should get to see how the market is faring. I have recently rebuilt this section, the live data section. Last year during some of this, we had a change of vendors. So the ones that were providing the information, that segment on the RealTracs, they didn't get redone, re-upped, and the RealTracs built their own system to kind of duplicate that. So that's where we get our live data. Our live data is pulled directly from the MLS, so we get to see what our real estate is doing, because remember that all real estate is local. Now we can look at California and the problems that some of the blue areas are having, but really it matters most to us what's happening local. Well, I live in Rutherford County. Let's look at this top one, Rutherford County entire, and it's going to pull up 9 charts. And we'll just see whether or not our market is crashing. Now, we've heard some people say, no, it will never crash. They're just as annoying as the one who say they are crashing, and the reality is generally not found on the extremes. But here we have live interactive Rutherford County. Let me slide this up and see if I can do it without losing the pricing trends. Anyway, we lost the top of it behind the top banner. But what we see here is this trends look like they're all going up. We do see a little bit of moderation. Remember how bad it was back there between 20 and 22 when things were just post-COVID and people had their fear of missing out and things were going way above asking and it was just crazy and short times to get her done. And then that was our peak. Now we are adjusting down, but we haven't really crashed because for a large part, the cost of inflation is keeping prices up. So you can say in one hand that inflation is bad because it's making it hard for you to pay your obligations, but on the other hand, they're helping keeping property values up. We see them coming down during the worst of it, but our rates have pretty well much been stable since December. They have been stable since December, but even leading up when the slight increase in Fed target rates and mortgage rates, we still see a very slow, gentle rise in property values. Now, if we want to look at the gray, what is the gray? If we see it right there, it says the gray. Let me make that a bigger picture for you. We go back to the gray where we are. The gray is the list price, the average list price. And the dark blue, which I'll have to pull it down just a tad for you to see that, reposition it. The dark blue that we see right at that pointer right there is what they closed at. See, if we hit that May, that is the I gotta get the right color. It's a small chart. It's not the right one. We'll get in between. We'll do it that way. So the average sale closed price is down 1.26%. That is not really crashing at 1%, I wouldn't think. But it is down a little bit, so we are moderating a little bit. So at least we're not higher than we used to be if you're looking to buy. But that gray was the average list price. Well, the list price, the average was at 610.7, 68 or 88, I think it is. The average sales close price was at 486. Now we also have mean. Look at the days on market on the mean and then the average. We see that we may be on the market a little bit longer, but what are our days on the market? At the very peak of it, it wasn't but about 100 days, I think. Yeah, 108 days was average. That is from list to close, when it hits the market till it actually gets closed. Now down here we have two more interesting numbers. The bottom two lines, the red and the one above it, are the days on market contract to contract, and then the blue line above it, if I can land on it, my thing is going to be to a close, market to close. All right, so those are very similar. But now this is just one market. Let's scale down and see our showings are still going up. They're doing well. You see this little bit of a shepherd's crook at the end of this. This is our seasonal change. We peak out about April, May. April is the glory season. Well, it's the same every year. That third week in April is usually the peak for moving properties. We see right around May it starts to come down seasonally. So we would expect to see some
some slowing down in showings over the next couple of months because they normally do that. It doesn't mean that much. Get back to our charts. Our inventory has not suddenly spiked that we would see if we were in a buyer's market. It hasn't exactly continued to tank like it would be a seller's market, but back here during 20 was when we started to see the inventory go down. That's when our big peak was. We got one more important one I want to hit you because you need to look at these to see how the individual markets may go. You see this, we got a little crazy during the post-COVID thing. It went up high, and now we're beginning to correct and go underneath it. But we're not in cray-cray land. We're not in crazy town. Speaking, let's talk about Woodbury to show you. Remember this chart here, pricing trend. See how they're pretty well much going up. Well, we're going to look at the city of Woodbury. It's a smaller town in a budding county, and what we see there, we still see the incredible increase in what people think they want their list price to be. It keeps going up, but has the actual close price kept going up? And we see that it really hasn't. I can't really put my finger on this without it really making the flag show up, but what we see in this chart right here is we see we were going up and we've just kind of leveled off. We have just kind of leveled off in Woodbury. Different real estate market, and all markets are local. All real estate is local. All sales are local. You're buying a house down to the neighborhood, and it's not crashed. It's kind of leveled out with these high mortgage rates. Now, if mortgage rates drop significantly and everybody's still fully employed, we might see the prices skyrocket again. But if we see people lose their job because of unemployment problem, because of other issues and not being able to make our obligations, we might see houses go back to the lender. We might see cars get repossessed. We're not seeing any of that yet. So we're still doing quite well. Well, I'm going to bring in this next little bit. It's been pulled up. I've slid down. Let me slide up to the top. This is the Federal Reserve's stress test. This was something that came out Wednesday. It's a nice publication where they say everything is going to be all right. Let me stop at this one first. The executive summary. What they're going to say, what this chart says is we got burned back in 2008. We didn't have enough cash to weather the storm. So banks nowadays have enough cash on hand to handle their losses, their expected losses. That's the whole big deal. The word is expected is our key here. Now, we have been padding the banks' bottom lines to make sure they're fully cashed up. The 2024 stress test shows that the 31 largest banks subject to this test this year have sufficient capital to absorb nearly $685 billion in losses and continue to lend to households and businesses under stressful conditions. The immediate years after the 2007 to 2009, which would be 8 in the middle, global financial crisis. Because remember, it really wasn't just 2008. It was the years leading up to it and the years leading after. Increased their capital, which have remained largely the same for all of these years. So they're just saying they learned their lesson, they're cashed up. Now, this one is on capital ratios. You hear some people talk about those. We're not going to go into that too much, but we will look at one thing, what they make on their assumption on their employment or unemployment, if you want to look at it, because they're two different things. Let's zoom in. Here we have Table 2, key variables into 2023 and 2024 supervisory solely adverse scenarios. Unemployment. They said, this was their test, that they could go from 6.4 to 10% in 2023, and they said they go from 6.3 to 10%. So that's what they're saying there. They were saying the Fed has said they tested them with that very high unemployment and with some major changes, and all the 31 major banks are going to be just fine. They can handle the losses. Don't you worry about it. Well, let's go see what the report from Wednesday was. This is from CNBC. These things will be everything that I'm using today will be in the description of the status chat, so you can go look at all of these in details. This is from Hugh Son. This is his at Twitter. His at Twitter is his name with a space in, with an underscore in between. Federal Reserve says all 31 banks in the annual stress test withstood a severe hypothetical turndown. This was Wednesday. Well, we can look at the bullet points real quick, although we're going to run long on this. Hopefully it is of value to us. The Federal Reserve System said Wednesday the biggest banks operating in the U.S. would be able to withstand a severe recession scenario. So we're told to be, don't worry, be happy. So here we have each of the 31 banks in this year's regulatory exercise cleared the hurdle of being able to absorb the losses. Those were expected losses of a certain size while maintaining more than the minimum required capital levels, the Fed said in a statement. The next one, this year's stress test included giants such as J.P. Morgan Chase and Goldman Sachs, credit card companies including American Express, and regional lenders such as Truist. So they're saying we looked at it hard and long, but here let's look at some of the stuff they claimed, if I can still find the spot highlighted. Here's their stress test. This I find a little bit difficult for me to believe that they can withhold this. Here we are. The stress test assumed that unemployment surges to 10%. Where are we right now? Around 4%. Commercial real estate values plunge 40% and housing prices fall 36%. So, in the markets I showed you, you have the tool. Did you see our residential real estate falling 36%? No, we just saw pretty well it's staying leveled out. So it doesn't look like that has happened yet. If it's going to happen at all, it hasn't happened yet. And we see that the Fed is saying they tested this, and let's go back over to that panel. I have to get off of that. They're doing a new thing where it brings this up. If I highlight it, can you want to exit? Do you want to LinkedIn it or email it? No, I don't want to do either of those things, so it's a little annoying. But the stress test assumed that unemployment surges to 10%. We're at 4%. Commercial real estate values plunge 40%. That's where our biggest threat, I think, will come, because so many people believe that the free money would be there forever and they could just keep laissez le bon temps rouler. We could just let them roll. And if we had have acted in time, if the Fed and the administration had acted in time when they printed all that money, if they had have thrown us into a recession early on, say in 2020, before inflation really got that high as it was, nearly 10%, maybe we would have already been out of the recession on recovery, and the commercial real estate companies would have been able to do the refinancing that they're going to need to do at the lower rates that would come down as a result of quantitative easing because of, the recession. So they'd have to throw us into the recession to justify lowering the rates. But if we could have got there quick enough, maybe we could have refinanced before the payments came due. So let's go back and look at what a response said about this. Go ahead and click my JP Morgan. JP Morgan, let me slide up toward the top. It says, JP Morgan, which was one of those banks, they said were the big one. JP Morgan Chase said its stress test losses should be higher than what the Fed disclosed. So this line, the headline is JP Morgan Chase saying, no, you didn't put enough losses in the stress test. Now, they're a bank. Why would they want to indicate they're at more risk than the Fed says they're in? Well, perhaps they believe they're in more risk than the Fed believes they're in. Remember, when somebody tells you something bad about themselves, this is generally more believable than if somebody's saying something good, because they're not going to disclose something bad unless they feel that there's a legitimate need for you to know it. So we go back to this. I want to point out something else. The same man, Hugh Son, is the one writing this report, as wrote the other one, and it was published the next day. JP Morgan quickly responded the next day, is what this is going to tell us. JP Morgan Chase said late Wednesday that the Federal Reserve overestimated a key measure of income for the giant bank's recent stress test, and that its losses under the exam should be actually higher than what the regulator found. So JP Morgan is saying the Fed is kind of fibbing you. They're telling you porkies, mate. They're just giving you what they want you to hear. All right, look at the next bullet point. It says the bank took the unusual step of issuing a press release minutes before midnight Eastern time to disclose its response to the Fed's findings. So the bank is saying, yeah, we don't think so, Chairman Powell. We think we are not quite as stable as you think we're stable. And they're telling them. So who do we believe? Do we believe the Pollyannas, or do we believe the clickbaity negative people that you see on YouTube, or do you believe somewhere in between where the information actually is? The error means JP Morgan might require more time to finalize its share of repurchase plan, according to a person with knowledge of the situation. I think there was only one thing I wanted to read down here. Yes, here we go. Under the Fed's table, it's probably going to give us our envelopes. We don't want to see that. There they are. It hides our text, so we'll step off of it. Under the Fed's table of projected revenue, the income and losses through 2026, JP Morgan was assigned 13 billion in OCI, more than any of the 31 lenders in this year's test. It also estimated the bank would face roughly 107 billion in loan, investment, and trading losses in that scenario. And we had at the top JP Morgan issuing a statement: we don't think we're as healthy as you think we are, Chairman Powell, Mr. Fed. Now, we see this on unemployment. We're getting towards our happy ending here. We have unemployment. California revises 2023 because 2023, just recently we see that California was doing the everything is fine, don't pay attention to the man behind the curtain, everything is going up, but they actually revised 2023 way down. Here I have it highlighted. The unemployment rate higher in 8 of the 12 months into 2023 than it was originally estimated. How much of the data, don't get paralysis by analysis, but how much of the data can you really take, even if it's government issued? Can you take your favorite podcasters and Twitter and TikTokers telling you that everything is good? Or do you just open your eyes, you go look at the market, and you see what's going on? Now, this is our last. We're going to wrap this up pretty quick on this segment. We have the BLS. This is our government, our Bureau of Labor Statistics. All right? CES, the current employment statistics. I always think about it being the situation, because what I'm looking for is this little link right here. Do you see this? Let me put it on screen. The current employment situation. We're looking for this link. We click this link and we're going to pop up the regionals. And I have pre-selected out of the map the Nashville, Tennessee Economic Survey. Summary here. Surveyed out from the area itself, not taking the national. These should be accurate. If we come down here to this, the over the year-over-year change selling prices received by producers for selected industries nationwide. You see that the general trucking freight lines, because diesel fuels and that crazy making everything electrical, that's been in serious flux, but pretty well much other things have been flattened out, going along not so bad. We're talking about employment here. 12-month, the over-the-year changes in wages and salaries. We say that we spiked up initially, but they're coming down. We're not really getting the increase in prices that we were expecting to see, but we're not really doing bad either. Let's go up to the unemployment at the very top. We see that the United States is, it says here, at 3.5. This is a little bit lagged because this is April. We're at 4, we went to 4 in May. So this is a little bit behind, but you can see how Nashville and Davidson County ranks compared to the national average. We're better off than the national average right there, in that we are about 2.2%. Overall, it's about 2%. Williamson County may be a little bit less at 2% flat. This is in April. We're coming up a little bit. Unemployment is rising. It's on our radar, but we're not nearly as bad off as the national average would be. So I think we can look at this in its entirety in another week or so when we get May's that will come out. They always run behind. But are we seeing unemployment being terrible in our area? Davidson County Metro, Rutherford County, Williamson County? No. Unemployment rate is still very, very low. We're doing good there. You saw when we went to my website, you saw that the markets are not crashing. They're just kind of leveling out, so things are still looking pretty good. Remember, we've got the devil of inflation that's going to keep trying to push prices up, and we're going to have to fight with that a little bit. But right now may not be a bad time for you to go ahead and get a loan, get a mortgage, buy a home. But what I would recommend you be very careful to get the full information from the lenders to see how, if you're being shown an ARM, an adjustable rate mortgage, or you're seeing an assumable mortgage, find out, do you have the capital for that particular house to buy out the equity that's already in that house? This is all outside of my boiler room. These are outside. This is a mortgage lender type question you would have to ask. I just want to give you a little couple of thoughts in the back of your mind as we look to this, because now may be a pretty good time to buy a house. It really may be. People are a little bit antsy on things, and so you might get a little bit more negotiating room than you think you might be able to have otherwise. If it had been a year earlier, you probably wouldn't have quite as much negotiation room. If you're selling, yeah, you can negotiate, but if somebody's asking to buy, they still want to buy. So the question is, can we get some reasonable professionals who are advocates for the buyer and the sellers to come together to make a workable solution? I think we can. I really think we can. I think it looks pretty good. There are some things that are bothering me. Will inflation continue to go? Will unemployment turn around and continue to go higher? Will we hold on our jobs? We're getting kind of stressed out waiting for those rates to fall because people have been overplaying that card for quite a while. All right, so let's wrap it up and get our numbers for today. Hello, I'm Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel, CallDelToSell. That's 1 L and Del, no spaces. Watch the demo on Real Scout and then call me and we'll set up your exclusive ad-free account today. All right, the last segment we do is always the numbers. Last week, 6/21/24, we had 21,635 in the opportunities. That includes the coming soon. That went up over the previous period. We had 4437 in the under contract still showing. That also went up just a tad. And the ratio went from 20 to 21% from the previous period, the ratio between those two numbers. This week, 6/28/24, we had 21,993 in the opportunities. They continued to increase a little bit. Let's be on your inventory side. And we have 43,29 in the under contracts still showing. We closed some out. That brings that number down just a little bit, and the ratio between them hit 20%. So, what do we see in this? We looked at all real estate's local. We looked at some local markets. We looked at a tool that you have, which is the website, my website, where you can go in there and look without me even knowing or harassing you or any of that kind of stuff. You just look to see that the market is what? It's not crashing. It's kind of regulated. That's not news. Maybe it was time for you to see that. And we do know that we have danger on either fringe of the argument that the clickbaiters, that the world is coming to an end, the market's going to crash, and everybody's going to be living in the streets, cats and dogs, and Stay Puft Marshmallow Man. The reality is always going to be somewhere in the middle. We are facing some challenges, and we do have a lot of bias in our media. So you just need to still watch both sides of every argument, but listen to what they're saying, because the truth is probably going to be a meld somewhere in between, and good information is what you need. I always say forewarning is forearmed. The actual expression is reverse that, but I say forewarning is forearmed. The original expression means if you're armed up ready to fight, then you don't need the early warning system because you're ready to go at any point in time. I think it's just the opposite. Forewarning is helping you know what tools you'll need to fight your enemy. So we'll see you next week. Appreciate you watching. Sorry this was a long one, but it just, some of the stuff that came through the social medias this week where people were saying the sky's falling, I'm tired of the sky's falling. I don't really hear that many people telling you that, but we do have some real risks. So let's get you into or out of the house of your dreams today. Appreciate you.